Hi everyone, my name is Louise Harty, and on behalf of Africa First, I'd like to welcome you to the Entrepreneurs Network virtual series, Accessing Capital in Unprecedented Times. Just to get through a bit of housekeeping before we start, on the left-hand side of your screen, you'll see links to the reception area, sessions, and networking. After each speaker, you'll have to leave the current window and join the next session by clicking on the Sessions button. On the right-hand side, there is an area where you can send us your questions throughout the sessions. And if you have a moment, please join us in answering the polls by clicking on the polls section. I hope you enjoy the sessions, and remember to connect with our speakers and attendees after the event by selecting the networking button on the left-hand side. You'll have 3 minutes per networking session to connect with various stakeholders of your choice. Okay, our first session for the day is about startups driving growth in a disruptive world, finding opportunities in crisis. I'd like to introduce you to our first speaker, Zachariah George, Chief Investment Officer at Startupbootcamp Africa, Principal at Nedbank Venture Capital South Africa. Zach is the co-founder and Chief Investment Officer at Startupbootcamp Afritech, the leading multi-corporate backed venture accelerator program in Africa. He is the founder of Cactus Advisors, a specialist corporate finance advisory firm, and micro venture capital fund specializing in high-growth, high-impact African tech ventures. Zach is a prominent angel investor in over 45 leading tech startups in Africa and has been featured on the cover of Fast Company South Africa, Destiny Man, and on several occasions appeared on CNBC Africa. In January, he was recognized as one of the top most influential persons in technology in Africa by the Financial Times. So, Zach, over to you.
Great, thank you. Thank you very much. Can everyone hear me? Okay, great. All right, perfect. Thank you everyone for tuning in, whatever part of the world you're in. I'm going to speak very briefly today about something that's very passionate to me. It's the growth and the exponential growth of venture capital in Africa, and the key role that corporates play together with startups in collaborating to grow the future of the VC industry. As was mentioned earlier, I have been an angel investor in African tech for the last 10 years. I've also co-founded one of the largest accelerators in Africa called Startupbootcamp, and have now launched one of the most pioneering early stage seed VC funds on the continent. So I'd like to just share some thoughts around the importance of early stage funding and growing and scaling businesses on the continent. About 15 years ago, can everyone see these slides? Just want to make sure that you're following with me. Yes, no? Just want to make sure if everyone, okay. I'm assuming I'd take silence as a yes. Okay. Of about 15 years ago, when I was at the business school at Stanford, I came across a professor called Randy Komisar, who's now a leading Silicon Valley venture capitalist. And he said something that really questioned the core of my being from a career perspective. And he said, of all the risks in the world, the most dangerous risk is the risk of spending your life not doing what you want, on the bet that you can buy yourself the freedom to do it later. And it's something that resonates very closely to myself when I work with entrepreneurs. A lot of people on this planet tend to be doing things in their careers, in their daily lives, that don't really reflect what their true passion is. Whereas entrepreneurs are people, that rare breed of people that are able to do what they want because they truly believe in solving problems, on finding a product market fit, and are willing to do it now, early, and they're not buying time to do it later. And that's one of the reasons why I moved to Africa 10 years ago and decided that we would help pioneer support, not just financial, but intellectual capital, market, and networks to help African entrepreneurs get to their true potential. If you look at the global population growth over the last few years and extrapolate that with data from the World Health Organization, over the next 50 to 80 years of the turn of the century, we are looking at an 85 to 90% growth in the population of Africa, where by the turn of the century, nearly 1 in 3 people on this planet will be from the continent of Africa. More than 12 of the 20 largest cities in the world will be in Africa. So we have to ask ourselves as Africans, or as folks that live in Africa, what are we doing to solve these challenges around communication, transportation, urbanization, food and water security, healthcare, education, financial inclusion. And if you look at some of the most innovative technologies in the world, they've always been able to use technology to disrupt industries that traditionally have not been digitized. And therein lies the massive opportunity, both from a producer and a consumer perspective. So when you have a population that's growing this quickly, 1 in 3 people will be in Africa in the next 80 years. And the purchasing power and the digital penetration of both mobile phones and the internet is increasing faster in Africa than anywhere else in the world. That's either a massive opportunity or a massive challenge, whichever way you look at it. And that's the reason why early stage VC is so important and critical. As I'd mentioned earlier, when I moved to South Africa 10 years ago, the word venture capital didn't even exist in anyone's lexicon. There was barely $20 million in venture capital funding on the whole continent um, in 2010, 2011. Fast forward 7 to 8 years, in 2019, we had more than $2 billion in VC funding. And not just the amount of funding, but the total amount, the average amount of funding at individual rounds has also gone up quite significantly from C to Series A to Series B and more. And what's interesting is, despite the global economic recession caused by the COVID-19 pandemic, Africa is the one region in the world where, for the first 10 months of this year, we've actually seen an increase in venture capital activity by more than 25%. The numbers in the slides are a bit outdated compared to the rest of the world. And one of the reasons for that is, like I mentioned earlier, the 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 problems that can be solved in Africa by technology, or need to have problems, not nice to have problems. So when you look at things like electronic health records, or the need for digitizing content from an education perspective at schools, or the delivery of essential financial services. Using technology to solve these problems is a must-have, not a need-to-have, and that's why you see more activity in the VC space in Africa. There's been an increasing focus on early stage African tech ventures, as you've seen in the last 3 years. The three epicenters of technological innovation have historically been Nairobi, Lagos, and Accra. Nairobi, Lagos, and Cape Town. And from an investment standpoint, we've had more than 250 VC firms invest on the continent. What's really positive is the fact that almost 100 of them are from the continent itself. So you've seen more traditional investment houses, be they individuals, family offices, funds, or institutions investing money into the continent outside of traditional investment um, targets that tend to be listed capital and property. One of the things I want to speak to about for all the entrepreneurs here, depending on what part of Africa you live in, is to understand what makes your city, your region special, and what are some of the key components of a thriving startup ecosystem. So number one, you need to have talented, tech-savvy entrepreneurs that create innovation, right? But that's not just developers, it's designers, it's people in digital marketing, people from top-tier technical and business schools that choose to go down a path of entrepreneurship and not necessarily just go and work for a corporate or consult in academia. You've then got to have a growing pool of risk capital from high net worth individuals, from families and VCs. So it's not just capital, it's the attitude towards capital that's important. You've got to have a greater degree of collaboration between corporates and startups. Now, why is that? Why is that important? It's important because it is very hard to scale businesses in Africa unless you have strong B2B relationships. So unless you're able to solve a route to market, the cost of acquiring customers is very high in Africa. So if you're able to partner with banks, with insurers, with telcos, with retailers early on through proof of concepts or pilots, it becomes a lot easier for you to scale without having to raise a lot of money. Number four, you need support from accelerators, from incubators, from co-working spaces, from tech transfer offices. And cities and regions of the world that are innovation hubs tend to also have a well-established entrepreneurial support system. And last but not least, you can't ignore government. The role of government is not to interfere, but to support. So what can government do? And this extends beyond just provincial and municipal. This extends all the way up to state and national government. It's to provide things like tax subsidies, R&D grants, and provide incentives both to entrepreneurs and to investors alike to make this a lucrative sector to be part of. So when you, as a founder, assuming you're one, look at where your business is established, and you got to think to yourself, which one of these five components, preferably three or more, is helping me and my business grow. And if you don't find that you have three or more of these components, consider pivoting your business to a region where you can get this, right? Because the last thing you want to do as a founder is just work hard and not work smart. Some important facts about the VC ecosystem in Africa and how to thrive that I've learned over the last 10 years as an angel investor, running an accelerator and running a large seed fund is you've got to understand the cost of acquiring customers. In Africa, it is a lot higher than in more established markets like Europe and the US and Asia. You've got to understand B2B business models versus B2C business models. And the reality is, although B2C business models are very sexy and very attractive and are easier to relate to from a consumer perspective, it's very hard to scale those without a lot of capital. So the reality is in Africa, B2B business models and B2B2C business models work really well. You've also got to really understand the difference between how your lifetime value relates to your cost of acquiring customers. So as a founder, you always have to keep that ratio as high as possible. I'll get to that a bit later. Like I mentioned earlier, irrespective of what sector you're in, if you're not working with large corporates early on, from a distribution standpoint, it is very, very hard for you to scale exponentially. You've got to learn how to acquire customers, how to activate them, how you retain them, how you create virality, referral networks, and eventually how you monetize them. It's important to think of how monetization of revenue, which is a 1980s and 1990s concept of I need to make more money, is now one of the last things to look at. Because a lot of companies today that focus purely on profit and breaking even aren't the most successful ones. The companies that are most successful from a tech perspective are the ones that understand virality and how you can grow your top line, as in customers, as quickly as possible. The last one I'll mention here is the importance of understanding things like price elasticity and quality. In the 80s and 90s and even the early 2000s, as a business, irrespective of whether you were a startup or an SME, you either competed on price or you competed on quality. That doesn't hold true for the most part anymore. Today, what you really need to compete on is, can you save people time and can you make their lives more convenient? And if you look at some of the most successful companies today in the world, tech companies like the Amazons, the Ubers, the Airbnbs, the Twitters, etc., they make people's lives more convenient. And when you get to a threshold of convenience and time saving, people become less sensitive to price. And that is an extremely, extremely important thing to understand. As a venture capitalist and an angel investor myself, some important points that I want to stress at before I take some questions is what do investors really look at when they're investing? And I'm sure you've seen multiple versions of this from lots of people, but I can tell you from an early stage investment perspective, I'll make it easy. There are 7 T's that we look at. The first one is we look at your team, right? At the core, we're looking for great teams. We prefer founders that for whom this isn't their first rodeo. They haven't done this. They haven't not done this before. We look for founders that are assertive but not aggressive, right? That are able to be mentored and coached, but have a really, really deep understanding of their market, right? Better than anyone else. We look for, and speaking of the market, we look at industries that have a very large total addressable market, TAM. So just as a benchmark, if you're in a business and you don't see your total addressable market getting to at least $100 million by the end of year 5, which is usually the longest you can predict from a projection perspective, it's really not worth a VC's time. We look at traction. There's nothing better than traction to prove to VCs, investors, and partners that your idea and your MVP can actually scale. And traction doesn't always have to be commercial revenue. Traction can be pilots, can be proof of concepts, but you need to show that there are willing buyers of your product and service, even if it's just a beta or an alpha test. A good benchmark to have, again, from a institutional capital standpoint, is a lot of people ask me when they should start raising their Series A. There is no definitive answer, but a good benchmark to have in mind is once you're doing 50 to preferably $100,000 in monthly recurring revenue, you're probably ready to prep for a Series A, which is your first institutional round. The other thing I want to mention is technology. Again, not all businesses have to be tech businesses, but technology is an enabler of scale. So if you have some sort of a patent or a moat or something that makes it hard to copy what you do, again, very lucrative to investors. We look for transformative businesses. How is your idea transforming an industry that you're going after, right? Not just incrementally, but fundamentally. So not sure how old the audience here is, but think of businesses like Skype, right? Skype or Spotify. These weren't new concepts, but they applied innovative thinking to existing industries. Skype was not the world's first voice over IP protocol, right? Spotify was not the world's first streaming service, but they came in and transformed the way people viewed a particular industry, right? And that's important. And that leads me into my next thing, which is timing, right? So often companies that are first to market bear the brunt of complaints, bear the brunt of inefficiencies, bear the brunt of customer churn. So timing's often one of the most important things in this market, but also one of the hardest things to measure because it's intangible. And lastly, a 10x return. VCs will not invest in you unless they can see at least a 10 times return, the possibility of a 10x return within 5 years, 3 to 5 years. A last point I want to touch upon is, irrespective of what industry you've come from, it's venture capital and private equity are often very, very unfairly put in the same sentence. Private equity is very, very different to venture capital. A lot of the metrics that are used to evaluate private equity investments or even late stage VC investments center around price to earning multiples, EBITDA multiples, and other things like that, and break even analyses. In early stage VC, a lot of that is completely thrown out the door. What's so important is understanding unit economics. That is, how does your marginal cost of acquiring a customer as a startup compare with the marginal revenue that customer gives you? So that very important metric I mentioned earlier, lifetime value to customer acquisition cost. If you can keep that at a ratio of 3 or more, you're winning. A lot of people talk about EBITDA margins. Honestly, in the VC industry, if you're a true VC and not a private equity masquerading as a VC, you don't care about EBITDA and break-evens, right? Because if that was your benchmark, you would have missed out on Amazon and Twitter and Uber and pretty much every tech startup out there. What you care about, though, is how do your margins change over time? So even if you have a negative EBITDA margin for 5 years, how is it getting better with time? That's what you need to look at. And you also look at your, how are your customers churning with respect to how they're growing, right? It's a lot to cover, so I'm just going to skim over it high level. And the last thing I'll say before I take questions is, people ask me a lot about valuation. Zach, how do you value a tech startup? How do you value an early stage venture? The reality is people assume that valuation increases with time or valuation increases with the amount of funding you receive. Both those arguments are complete hearsay. I've seen a lot of startups that have been around for many years that are worth nothing. or worth very little. And I've seen startups that have raised tons of funding but are still not really worth a lot of money. And the opposite is true as well. So the only real metric that validates what your value is validation, i.e., have you found a product market fit and have you found a problem solution fit? And once you get those, your valuation automatically is fair. All right. The last thing I want to say is a quote from my one of my favorite and most inspiring leaders of all time, the late Nelson Mandela, when he said, and this is especially true for founders, it always seems impossible until until it's done. So I'm going to stop there, and I'm happy to take questions and help in any way I can. Thank you for listening to me.
Thanks so much, Zach. We have had a question. Is there a benchmark for profitability forecast that SMEs could use when trying to get an investor on board, besides showing or projecting $100 million turnover in year 5? Is there sort of a ratio that they look at?
No, again, like I said, and sorry if I'm being a broken record here. There is a big difference between SMEs and startups, right? SMEs are lifestyle businesses. The majority of African, South African, and emerging market wealth and GDP comes from SMEs, right? Startups are very different. Startups are not SMEs. SMEs have one goal, and that is to create value for the founders and to create profitability and a continued sustained lifestyle for the founders. Startups do not need to be profitable. What startups have to do is create exponential customer growth. As I mentioned before, Amazon until 2 years ago was not profitable. Why? They valued at $2 trillion, more than the GDP of Kenya, Nigeria, South Africa, and Egypt combined. It's because they create value for people. So so again, just be very careful of using the word SME, because a lot of founders are not startup founders, they're SME founders, and their objectives are different. So if you're an SME and you're growing nice and slow and making money, do not approach a venture capital fund, because they will say no to you, right? So it's very important to understand that so a lot of the things that I said are geared towards technology backed founders. So that's a disclaimer I would say there. um, in terms of sorry, I mean, I think you was a question around profitability, or
Yes. So when
yeah,
pitching to an investor, do you have to show
doesn't
profitability or
no,
not necessarily?
no, you don't. I mean, if you're talking to a real serious high quality investor, no. The really shitty ones will ask you stupid questions like, when do you break even, what's your EBITDA in year 3? If you're talking to people like that and you're a technology startup, you're talking to the wrong investor. It's dumb money. A dollar from myself or a dollar from the person next to me is not the same. Not all funding is created equal, for lack of a better word. So there's as much as investors do a DD on you as a founder, it's even more important for you as a founder to diligence your investors. Why is that person giving you money, or that entity? What do they add from a strategic perspective, from a network perspective? Why are they giving you money? Are they giving you money to tick off a box, to satisfy a checklist, for CSI reasons, for marketing reasons? How can they help your business succeed? What's the vested interest? So if you look at classic VC, and I'm going to say this just one final time, most top tier Silicon Valley VC funds are run by entrepreneurs and people that have run accelerators and incubators that work with founders. Unfortunately, most VC funds in emerging markets in Africa are run by bean counters, which is essentially people that work in private equity and have CAs and CFAs. So they look at the world through spreadsheets. Founders are not spreadsheets. Founders are people that get customers. So I'm going to throw that question back to whoever asked it, saying, depends who you're talking to. If you're talking to a second tier VC in Africa that doesn't understand venture capital, yes, they're going to ask you for how profitable you are. Is that the right person to be talking to? If you're a truly tech scaling company, probably not. So short answer is profitability should not matter. But to some investors, sadly, it does. And then they end up making bad choices. sorry, I'm quite controversial, but I do speak from many years of experience and facts in this industry. So
No, for sure. I think that's a great, valuable insight as well to think, it makes sense if an entrepreneur is having a look at your potential startup. There's got to be a line where you are open-minded, where you do buy into the concept at some point without having to
yeah, I
prove
mean,
the profitability.
sure. I mean, the best example of this, I mean, sorry to say this, is it's one example, but there are so many more. There were several South African investors that were shown Uber's business model about 6 or 7 years ago, and they all said no because Uber wasn't making money. That's the way South Africans and African investors think. They think I need to make a profit. And I say this again, the world's most valued companies from a tech perspective, the Amazons, the Facebooks. Facebook is a little different, but Amazon, Twitter, Pinterest, Dropbox, Tesla, they don't make money. They don't. I need to repeat this 100 times. They don't make money, but they create value for customers. They make people's lives more convenient, and they grow their top line at ridiculous numbers. And that's value, right? Does anyone care that Amazon isn't profitable or wasn't profitable 2 years ago? No, I get my goods delivered to me in 24 hours if I live in Kansas or if I live in Louisiana. It makes my life better. So investors will always invest money in businesses that create value for customers, right? So it's a very hard concept for people that haven't understood Silicon Valley to understand. It's getting better. It was a non-conversation starter 4 years ago, but gradually we are finding African investors understand this concept. I'm a little biased because I happen to live in San Francisco, and I understand how Silicon Valley works. But for those that haven't lived and spent time there, it's very hard. You're still trying to, evaluate a company based on an investment banking or private equity spreadsheet, which it's unfortunate that people still think that way. It's a pity. The world has changed. So I think the one sort of statement that I say to people that still have a 1990s or 1980s mindset is, I ask them, hey, how do you book travel when you go on a holiday? Do you still call your secretary and make a booking? Do you still go into a flight center, or do you book it on Booking.com or on Expedia? Oh, no, we use online travel bookings. Oh, okay, cool. How do you learn your courses online? Do you still pay for a tutor, or do you use Coursera? Oh, we use Coursera. How do you take taxis? Do you call a hotline? No, we use Uber. So I'm like, if you do all that in your personal life, why are you investing to companies that are contradictory to what you're saying? You're being a hypocrite, right? So
Absolutely.
you're a consumer of companies that are not profitable. You
Mm,
enjoy the benefits as a consumer, but as an investor, you're a complete hypocrite. So sorry. I do I call people out all the time because the industry needs to change. So
absolutely.
anyway,
The way of the thinking.
yeah.
And just being mindful of time, we've had a question, are there any books that you would recommend to the audience, or what is your favorite top book that you would gain the most valuable insights from?
There are so many, but I would say, I mean, if you were to boil it down to like a couple of books, I'd say there's one no-brainer. It's called Zero to One by Peter Thiel, the founder or the co-founder of PayPal. It talks about how to build exponential businesses and grow your business from 0 to 1. It talks about the evolution of PayPal, the evolution of Skype, the evolution of Spotify. It's just an incredible book that talks about how to think exponentially. It's one of the most amazing books in this sector that I've read. The other thing that I will recommend from an African perspective is a book called The Prosperity Paradox. It's co-written by Clayton Christensen, the late Clayton Christensen, one of the godfathers of innovation, Efosa Mojo, and Karen Dillon. And it talks about how um, the most successful entrepreneurs are entrepreneurs that create markets when none existed before, right? And the moment you start looking at market creating innovation and not just iterative innovation, so you know so the silly example is, anyone can build a better BMW or a faster car, but the moment you change the game and build an electric car, you literally take over the market. But apply that concept to any industry. When you create markets, I mean, micro insurance is a fantastic example, right? Insurance has always been for the wealthy. And suddenly you look at saying, listen, what if I create a product that where insurance does not become a grunge purchase, but it becomes a necessity? So the prosperity paradox talks about how not just African innovators, but it's so relevant to Africa, is saying when you create markets when none existed before, you take over an entire ecosystem. And those are two books I'd recommend. There are so many more, but as a starting point, 0 to 1, Peter Thiel, and The Prosperity Paradox, two great books to recommend.
Super. Thank you very much. There you have
Sure.
it. That's from Zachariah George, Chief Investment Officer at Startup Bootcamp Africa and Principal at Nedbank Venture Capital South Africa. Thanks so much for your time, Zach.